Okay, go ahead.
Good afternoon, everyone. This is Dan Herman, President and CEO of Ziegler. Joining me today is Lisa McCracken, our Director of Senior Living Research. We're very happy to be presenting here today to the annual CHSM gathering, and we're also very proud to be a leading sponsor to CHSM. And we know this is a long-term care breakout group, and hopefully it's a nice day in March because you see a wonderful March day behind me here in downtown Chicago. That's Wacker and Madison behind me, and our offices here in Chicago. So it feels like a March day for sure. But we're here to present the annual State of Not-for-Profit Senior Living and Care with a particular focus on you all as CHSM, United Church of Christ, sponsoring senior living organizations around the country. We're going to cover this in approximately 30 minutes. Lisa, if you can go to our table of contents as I give I'll give the overview of Ziegler here. But we're going to cover this in about 30 minutes and then have 30 minutes of Q&A. And we want this to be very focused on the trends around the country today, coming as we come out of the COVID environment. And we also want to thank you all as providers for having done such a wonderful job in the last, what is now approximately a year, dealing with this COVID pandemic. But there is great opportunity in not-for-profit senior living and care, and we want to address that. But just quickly about Ziegler as a reminder, again, very proud to be your sponsor. And as you know, we sponsor a number of the faith-based organizations around the country in not-for-profit senior living in the leading age universe. We are a boutique investment bank, so pure investment banking, capital markets, and proprietary investments and fund management. Two of those funds are the Ziegler Linkage Funds. And in fact, by this time, we likely will have kicked off the Ziegler Linkage Fund 3, and we'll talk about that later on. Next page, Lisa. We have a wonderful team covering the country. So you all know a number of these Ziegler senior living team members, and our team's 40 plus our capital markets team, research, corporate finance. We have 120 folks in investment banking. But we're very proud of is the tenure of our leadership in this team, and we serve a number of you, again, around the country. So you should see some familiar faces from your parts of the country. Next page. This past year, 2020, as we sit here in March of 2021, was profound. So we have on these two pages our fixed rate financings as well as our bank financings. And we did 46 transactions, about 40 of which were after the COVID environment. And we'll talk about that a bit, but we raised nearly $3 billion of capital between fixed and bank capital, a portion of that for you all as providers. And it was a very unique year. We worked very hard to help open up the markets back in April and May, and then things flowed relatively smoothly from June on, which was not predictable when we were sitting there back in March and April. And very proud to be the national leader in not-for-profit senior living. These are the fixed rate rankings. As you see, we typically do about 50% of the market. And it's similar for bank financing. So very proud of that and happy to serve many of you. Next page. And then as part of that is our commitment to education that we're very proud of. In fact, we have Lisa in her position as Director of Research, and she's going to highlight some of these educational efforts we give back to the industry. Lisa?
Yeah, so appreciate the opportunity to be with everyone today. This is an overview of our commitment to all of you from a resource standpoint, from a research standpoint, thought leadership standpoint. So to highlight some of our education, the research that we produce on a given year, and you'll see a lot of that weaved throughout the presentation today. And many of you participate in a lot of those surveys, so we thank you for that. One thing that we want to offer up to you is to be a resource. Many of you do take advantage of that, but above and beyond, the core investment banking services that we offer, is the opportunity to gain additional insights into how the sector is behaving, some best practices from your peers. So this is a bit of a summary. I would tell you, you can find a good bit of this on our website, but you can always reach out to myself, Dan, or the respective banker in your region. So that's an overview of our research in a brief summary slide there. So I'm going to start off with just some observations as we look back on 2020. As we know, we wish we could, just flip a switch at June 1st and it'd be a whole new year. It's a new year, but there's certainly some carryover from what we've been going through in the past year. And this will lay the foundation for when we get into what do we see for 2021 and really as we start to come out and emerge out of the COVID-19 pandemic. So some of the key themes, and this has really been consistent from day one, really since I think it was the end of March, we were hosting bi-weekly webinars with COVID updates and information we were seeing from the markets to occupancy and trends and so forth. And really from day one, variation has been the theme. It really depends on the organization, the community. Everybody's taken a hit. We know national occupancy is down, but the level of that impact has definitely varied. The life plan community model has held up the best, and I'm going to reference some articles and different resources that have tied some metrics to that. But, the skilled nursing area clearly is the one that has gotten hit the most. Workforce, we can't not talk about the key things without talking about workforce. But as a reminder, we've been talking about workforce for a number of years. So I think some of those pain points were definitely exposed to a greater degree during COVID-19, but we're going to be talking about recruitment and retention for some time. We know that the complexity of our business continues to increase, and those that entered the pandemic on the weaker front are those that are struggling and are going to struggle to really come out of the other side of COVID-19 in a strong position. So Dan's going to talk a little bit about some of the consolidation, which we definitely continue to predict that activity and pace is going to continue to be pretty active. I mentioned the skilled nursing environment. That's another trend that is not a new one. We were talking about that for a number of years, and many of you have been taking a look at, all right, what's our unit allocation and what's our commitment to skilled nursing and private rooms versus semi-private rooms. And so we want to talk a little bit about what the future of skilled nursing is. We know it's going to continue to be pressured, but we also know that there will continue to be demand, and we're going to reference some of our rationale behind that. As I mentioned, Dan's going to talk about some of the consolidation, sponsorship, transition, and also technology. If there is a silver lining, and there's a couple, technology has definitely been one of them. And then the low cost of capital. We would not have been able to finance probably as many of those projects and providers that Dan had mentioned and showed on the previous slide had the capital markets not been in such a favorable environment. So we anticipate that will continue throughout 2021. And this is just really one of the pieces of evidence or good resource to have when we reference that the life plan community really performs the best during COVID-19. And we know there's, again, exceptions to this, but this was an article that was produced in the December issue of the Senior Care Investor. Generally, this publication is a little heavily more slanted toward the for-profit side of things, but they did a really in-depth article on CCRCs during the pandemic and pulled in some data from NIC on occupancy. So essentially, the not-for-profit entry fee communities are the ones that have fared the best during this. We know that staff turnover, even though that can continue to be a thorn in the side for many, it's generally lower than some other community or facility types. And the strong housing market has absolutely helped the life plan community model. So that's one of the differences when you look back at the recession from 2008, 9, and 10. We're in a very different spot economically in the housing market. So Dan's going to talk about some growth observations and highlight some of the different areas that I teed up. Dan?
Yeah, so then as it relates to our not-for-profit sector growth observations, and again, we try and use the words in the senior living and care market, knowing that the senior living and entry fee side played out nicely, as Lisa just highlighted, during the COVID period. Growth had been picking up fairly well prior to COVID. At this time last year, so many of the not-for-profit organizations were advancing on strategies to grow across the sectors I'm outlining here today. So new location growth had been picking up, and then COVID, of course, put the brakes on that. We have a few providers in particular. It's usually multi-facility providers coming back to new locations, and we financed one in Fort Worth for MRC. But I really would encourage not-for-profits to not forget about new location growth in the form of full new communities or boutique settings of just independent living in urban areas in particular, or in college towns, because you'll see in a moment how we're going to highlight the private sector or the for-profit sector continues to grow at a rapid pace. Not-for-profits have done a wonderful job reinvesting in existing communities, and that is where not-for-profits have excelled. The vast majority of that $3 billion of capital, other than that one new campus, went into expansions, repositionings, modernizations, fresh AL memory care, nursing, et cetera. and then the balance went into refinancings. But about 2/3 of that capital went into existing communities. So continue to think about maximizing existing locations. And then in our middle bullet there, growth through affiliations and acquisitions has been accelerating for decades. You've heard us talk about it. It was very predictable following in the coattails of health systems, and that has continued and now has accelerated during COVID. As we sit here today, we have a record number of assignments here at Ziegler, about half not-for-profit, half for-profit, about 24. Almost all are smaller organizations or single sites that are under some form of pressure that we're going to highlight in a moment. And then Lisa will highlight later in detail HCBS, where not-for-profits do a nice job at building that into their business mix and revenue streams. About half of the leading Age Ziegler 100 organizations have HCBS platforms. A lot of those are in partnerships, and growth continues to happen there. Now, on the for-profit side, private sector, home health, home care, hospice is booming, and the public company stocks are almost at all-time highs. So, again, encourage that as a diversification as part of your growth efforts. Next page. So here's the top 10 systems in the leading Age Ziegler 200 as to be able to highlight for the whole industry the growth of not-for-profits. And you can see we were in a very strong growth mode from the 90s up until the Great Recession. And there's no question the Great Recession pulled back the not-for-profit sector and led to a certain number of monetary defaults and bankruptcies, which was very unfortunate. So while not-for-profits have excelled at entry fee CCRCs, life plan communities, they do get exposed during pandemics or during Great Recessions, and growth definitely slowed down and then started to pick back up in the mid-teens coming into COVID. A lot of that growth has been independent living, as I noted earlier, and then it's being offset by the continuous decline in total number of nursing units through combinations, reductions in beds, and sales of obsolete nursing homes. Next page. So here we have the CHISM, United Church of Christ sponsored, 9 systems that are part of the leading Age Ziegler 200. So hopefully most of you are in the room. I bet all of you are in the room. And this is a good reflection of the leaders of CHISM and UCC. And I'll just take a moment to say, and I'm sure it's already occurred at the meetings, or I guess at the virtual meetings, congratulations to Laverne Joseph as he's retiring from Retirement Housing Foundation. We appreciate his support. We've been a banker to RHF for years, and obviously Laverne's done wonderful things for the sector, in particular in affordable housing. I'm sure so much more has been said, but we thought we'd take a moment here from Ziegler to note that. So congrats, Laverne, and good luck on your future endeavors. And then when we look at the growth of the not-for-profits, and go ahead and go to that page, Lisa. Actually, go back. I'm just going to ad-lib here and say, continue to think about the appropriate size of your organizations and what's appropriate for scale in order to continue to grow and have the depth of management team needed to compete down the road. So when I mention consolidations happening, a number of the systems on this page have added communities through affiliation and acquisition. So if you're smaller and if you think you're challenged and you want to sustain not your organization as a not-for-profit enterprise, please don't wait too long. If you think you need to reach out to someone, reach out to one of your UCC peers or other not-for-profits in your region. Next page. So on the growth, we're noting this breakout. If we can glance at this nice chart that Lisa did through the CFO hotline, and again, thank you for everyone that participates in the CFO hotline. You can see we did these surveys, one in March and one in August, around the different types of growth that I just highlighted. So unit expansion, new community affiliation, HCBS platform. And you can see that by the end of August, HCBS had elevated up, see that on the right-hand side in purple, up to 28%, saying, yes, we want to grow through that. And then a tug down on unit expansion. New community and affiliation continue to be the same response, so that's good. And then you see the breakout between multis and single sites on the right. And the multis response rate is at a higher level across the board, as you might expect, because once an organization is a multi, they generally have an orientation to want to continue to grow. Next page. So this is back to we like to use the word private sector for the for-profit growth. It is capitalism working through the marketplace, and the for-profit market has been booming. Go back and take your eyes to 2010 and 2011, where they were roughly equal, the blue line being not-for-profit. And coming out of the Great Recession, a substantial acceleration of growth of IL, AL, and memory care. They put memory care and assisted living on these NIC stats. Now you see the tug down on AL, but it's still at 6% growth. And it's really been on the for-profit side, the vast majority of providers generally pursuing IL with AL and memory care. Now, yes, there's been a slowdown on the orange line for-profit independent, but it's down to 10% year-over-year growth. You blend the two together, it's 8%. That will probably tug down to about 6% when the next quarter stats come out for the two combined, and then start to elevate. All I can tell you is the for-profit sector has a substantial amount of capital lined up, ready to reinvest and ready to acquire, because there's so much capital in the world sloshing around the markets. So do not assume that the for-profit growth is going to slow, because Lisa's going to show you a demographic chart in a minute that's posted in all of their offices. And then you see the not-for-profit growth tug down to just 1%. And that's because we're seeing limited new locations, disposition of obsolete, that's okay, expansion of existing communities, that's what's leading to the 1%. Really like to see that get back to where it was 3 to 4%, which is a combination of new locations, expansions, and some acquisitions. Next page. So here is this chart that we have tracking every not-for-profit ownership change. And just since 2010, we're now up to 762 through the end of 2020. Lisa will keep cleaning that up a bit because some of the news stories don't come in till the end of the first quarter. So that'll probably end up at 770, 775. Isn't that amazing? Since the year 2010. And that's a combination of the larger mergers such as Covia that is closing soon into Front Porch, but more often, say the one on the left, the Sunset Community in Toledo joining Otterbein. That counts as one. And this also includes closures and dispositions. So we know consolidation is happening, and we have a newsletter that reports each and every one. If you'd like to receive that and you're not getting it, let us know. Next page. Go ahead, Lisa.
Yeah, so I'm going to pick up here just with some outlook in 2021. So what does, we know, again, this is not a line in the sand where all of a sudden we're in this post-COVID era, but, what are changes that are here to stay? What are continuing threats? What are some opportunities? And Dan had referenced the demographic slide, and then we definitely see this as a continuing opportunity. We know that disproportionately COVID-19 has impacted the older adult population. But when you are looking at the sheer numbers where we are, and we still have this highlighted 2020, when you look at 2021, we're over 24 million individuals, 75 plus. So the COVID-19, despite the significant numbers there, is not going to change these demographic predictions. So, so there will continue to be a demand. We need to change and we need to pivot with the changing times. But this is one of the reasons why Dan had referenced the private sector being very bullish long-term on the outlook for seniors housing and care. So what is your future? Often people have said, is there going to be pent-up demand? And I think, the question is we're not sure. We know that, with the vaccines rolling out and the communities being really the first to be vaccinated, we've anecdotally heard some communities saying they've gotten calls through their marketing department saying, hey, if I move in, can I get vaccinated quicker and so forth. But the biggest issue is probably on the care side when you think about the demand for the caregivers. It's tough, as you know. And, while the skilled nursing area is going to be pressured, we also know that when you look at the demographics, the caregiving ratio is going to drop dramatically. So it's the percentage of unpaid family or friend caregivers out there to care for older adults is dropping dramatically as our population ages. And so that's something to always consider and think about with those demographics. The other thing, we saw this phenomenon after the recession or coming out of the recession, once the residents do start to move in, they're going to be older because they wait a little longer. They're probably going to be a little more frail. Length of stay is going to be reduced. You're going to see a little bit more of that turnover. So we are going to see those dynamics. We really were transitioning out of that and in, I would say, more of a stable environment coming into the pandemic, but I think we will see that same pattern as we did see with the Great Recession. But there is going to be increased demand for transparent communication, the safety measures, clinical capabilities. I think where some of the communities got into trouble is, the high-end hospitality focus that's just the IL memory care with more limited clinical capabilities, or a little more pressure during COVID-19 to respond just because they did not have those resources, or at least the operational framework to address that level of clinical expertise and demand. But as I mentioned, skilled nursing area is going to continue to be pressured. We do anticipate there's going to be more closures, particularly in those rural areas. But there is a reality there's going to be demand. I talked about the caregiving ratio. The other thing to know about is that the baby boomers are less likely to have children, also more likely to be divorced. So there are just some sheer traits of that cohort that will require additional support. So is the gap going to be filled by those providers on the care side? And then chronic health. The unfortunate thing is the statistics around, everything from heart disease to obesity to diabetes to anxiety, depression are greater in the boomer population than previous cohorts. So their health generally is a little more challenged than some other older adult populations. This is just an FYI, something that we're going to continue to watch and to follow, and we've gotten questions about this, but there has been some research coming out of 2020 around population migration, particularly out of the high-cost urban areas, and what does that mean? Has that been a short-term thing? Is that long-term? So we know that urban density has been a bad thing during COVID-19, and we have seen that out-migration. We will see how many of those temporary housing moves do become permanent. The one thing to point out, and I know many of you serve the lower income group, often this story in the map that you see here is of the sort of the mid to higher income group, that low income, homeless urban and rural areas are less likely to have some of these options and are really, it's going to change the dynamic of the demographic there in many of these urban areas. So small urban is a good bit of the focus where we're hearing some chatter in the private sector around active development. And then Dan, I'll just let you comment further on the private sector that we anticipate to see that continuing to grow, and then as well as ongoing consolidation, and I'll pick back up again.
That's right. So this is a nice chart we pulled from Senior Housing News, where they surveyed the broad sector, but they tend to have a much higher percentage of for-profit or private sector responses, noting that when do they plan to resume projects that were canceled. So you can see some percent just followed through in 2020, first half of 2021, and second half adds up to 66%. That ties back to my comment where we know as soon as investors see the light at the end of the tunnel, they're going to follow through on projects that were pent up, that had zoning, that had their entitlements and are ready to go, and they'll watch occupancy very closely. So if you don't already get the NIC map data for your region, if you're in a metropolitan market, the top 100 markets, we'd highly recommend getting that, because the for-profit side follows the occupancy data very closely. And again, they'll have plenty of money on the sidelines to invest. Next page. So we noted the consolidation and dispositions earlier, but we've continued to monitor the mega trends around this consolidation. If you can take your eyes down to the chart, this is just life plan communities, because we have the listing of the approximately 1,950 life plan communities. About 80% are not-for-profit. The majority of the for-profit life plan communities are already in multi-facility providers. It's very rare that a for-profit would just be a single location. So you can see from 2009, the gradual movement towards life plan communities being owned by multis. It's just more evidence of what we know. Again, we're very, very, very supportive of our single site clients, and many are in great markets. So the folks that are feeling pressure, as you might imagine, are facing growing complexities related to healthcare, financial pressures, C-suite retirements, and turnover is often a time where folks will look up. I mentioned that Sunset folding into Otterbein tied directly to the retirement of a longtime CEO, and that was a healthy community. That's definitely a driver in many of the affiliations. And then competing for workforce, competing for management, cost of technology, and so on. So we know this will be gradual. It's not immediate, but you can imagine what's likely to occur over this decade of the 2020s, making it more and more difficult for any single site that's not in a protected market. So if you are a small organization or a single site, focus on maintaining high occupancy and being the leader in your market, which might be a rural market or a smaller market, to be number 1 or 2 in your market, maintaining strong occupancy, which almost always translates into financial success. Next page. So Fitch has put out an update on the sector, and it was great to see that they reinforced what the senior care investor also noted, and that is the not-for-profit senior living sector actually is stable within the framework of all of the challenges of COVID. So you may have said, my daily lives have been miserable or a challenge, and we faced all of these challenges, but with many of you having an entry fee base that acted as a stabilizer, and our not-for-profits frankly shined on a relative basis relative to the entire sector, and occupancy held up higher than the other sectors. And so there were very few downgrades specific to COVID. Most of the downgrades were a combination of new, mostly related to new debt on projects. So we'll keep pushing out information on this Fitch news as it comes out, but they also noted the M&A activity on the rise, and then they also pointed out what you all may have been sensing, and that is the residential real estate activity is actually helping on sales and should continue to help as we roll into the spring quarter and seniors get more confident moving back into communities. There's ready buyers for their homes. Next page.
Yeah, I can speak to this one, Dan. So this is just a little bit of a graphic, and then, often it's interesting, that article that we referenced from Senior Care Investor around the life plan communities and CCRCs holding up the best. The author had referenced another expert in the industry who we had known for a period of time at the beginning of COVID-19, said that, I'm predicting that life plan communities are going to struggle and the nursing homes are going to be the shining stars at the end of COVID-19. Well, it was the opposite story. So many people have talked about, what is this value proposition for the life plan community? What does this look like moving forward? And I referenced earlier, it's this combination of the amenities and hospitality with that care element. And we always know that's been a delicate balance, particularly on the sales and marketing front. But it's how do you do that in a subtle way without, selling to independent living, residents, a community filled with, wheelchairs and walkers and so forth. So you want that active aging and living. But I think what we're going to see is a lot of this prevention and wellness focused, and that care is not necessarily tied to a level of care, or specific setting. How can you use technology to advance that? And this is really the life plan community proposition. I pulled together a quote, which I thought was really interesting. It came from Senior Housing News, and it just says, protecting the well-being of the population must form the foundation of everything from building design to daily operations, with hospitality layered on top. So it's this well-being piece, this wellness piece and care piece within the hospitality framework. So I just wanted to acknowledge that. Dan, I'll let you make some comments on technology, then I'm going to wrap up with HCBS and some additional closing thoughts.
Yeah, so it has been wonderful to see the advancement of technology in not-for-profit senior living, and our not-for-profit providers and Chisholm providers have been part of that. So that has kept up across the various elements of growth that we've been highlighting, and our Ziegler linkage funds have played, we think, a meaningful part. You see 7 different themes here. We don't have time today to walk through all of them, but my gosh, on telehealth solutions, talk about being advanced. I mean, that is one of the silver linings of COVID, and that's been the advancement of telehealth. You see on this next page some of the themes that we've featured about telehealth. And we have a leader in telehealth investment banking. His name's Grant Chamberlain. We did a report called Deconstructing Telehealth. We're on our 3rd edition. If anyone would like to receive it, just email Lisa or myself. And it's just going to continue to grow and include many forms of wearables like this. Some of you are users of Virtue Sense from the Ziegler Linkage Fund. I was on the phone with their CEO last night. They're continuing to boom. And then now they have a vital monitoring telehealth element that you probably will have heard about by the time of this session. And then remote patient monitoring is so popular, it's now called RPM. So if you hear RPM, people around telehealth are referring to remote patient monitoring. And then there'll be just lots of advances on artificial intelligence. Lisa, if you go back to the previous page quickly, though, another area that's become the norm has been communication and engagement solutions and resident engagement, which is tech-enabled. So CareMerge is in the fund, and they're one of the 5, 6, 7, or 8 players in that space that used to have 1 or 2. So a lot of players have come out from different regions in the country. At this point in time, it's common for our provider clients to be using different forms of resident digital communication or resident engagement that's technology driven. 10 years ago, didn't exist. Now it's becoming the norm. And then on the workforce solutions side, companies in the fund that many of you use include OnShift and then PayActive, Arena, and there's others that aren't in the fund around technology-enabled workforce. So it will continue to unfold and explode. And if you go over to the acute care hospital side, physician service, home health, payer side, it's just exploding. So we'll continue to mine as much of that as we can using the fund, the Ziegler linkage funds, as a way to communicate that information back to the marketplace. Back to you, Lisa.
So I wanted to comment on the growth of the HCBS platforms. And Dan had referenced earlier about half of the leading Age Ziegler 200 have some type of an HCBS platform. We have heard, and we did a survey on this, about 40% of those providers said that the not-for-profit said that they have actually seen an increase in the demand for their HCBS platforms, whether that's home care, home health. And if you think about it, occupancy is down, population is still aging, people are getting the support somewhere. And so, one of the things you can see is this graph, and it may be a little hard to read, but I'll explain it here and you can at least see the colors. It basically shows the post-acute referral trend pattern coming out of the hospital. And this goes back, from January 2019 all through the end of October. And you can see where we hit a bottom in April with COVID-19. And so we have seen an uptick again as people are getting more outpatient procedures, needing some rehab. But what we have not seen is that same recovery in the levels of referrals to nursing homes. What we've seen is growth and an uptick in the referrals to the home health agencies. So interesting data, continue to watch. We know, as Dan referenced, the publicly traded large for-profit home health agencies generally are doing pretty well and pretty active. I highlighted companion services here. That's not a new thing, and that has ebbed and flowed over the years, but we are hearing more and more about it. As we know, social isolation among seniors as one sort of demographic group that has really got a lot of attention during COVID-19. We know even many of you in your communities have said, that's been one really downside of the pandemic, of the mental and physical decline due to social isolation. So we're seeing a bit of a reemergence on this companion care side of things, and something that we'll watch. A few additional observations before we wrap up is really one of the key themes moving forward is going to be choice. We all had to pivot very quickly in 2020 around pivoting to virtual, whether it's virtual marketing tours or delivering groceries and so forth. So it's that, it's this choice and flexibility. It's when I want it, where I want it, and how I want it. That's everything from activities to dining to, procurement of services. So it is going to be designed for resident sensitive. It's staffing, it's flexibility, alternative models. So what'll be interesting is once we do fully get to a point where things can completely open up to in-person gatherings and so forth, what's going to be the ratio of people that choose some of those in-person versus sticking with the virtual elements. So that on-demand economy has a role in senior living and care, and we would encourage you to really think from an innovation standpoint of how to play in that. And I referenced earlier about wellness and prevention. We definitely see that that's going to be a big part of the continuum model moving forward. And I referenced virtual sales and marketing approaches. Those are here to stay. When you look at funds and philanthropy and development, those virtual events are going to have a long-term part of the strategic plan there. Reference social isolation, I think Dan covered technology. And then Dan, I'll let you make any final comments on capital in 2021 and then closing remarks.
Well, we had a wonderful year extremely attractive capital in the second half of the year after the disruption by COVID, and that followed the mega trend over the last decade since the Great Recession. We still should have a very attractive market through the first half of the year, and for the year, as the Fed is committed to keep short-term interest rates down. But with the new administration coming on board, there likely will be volatility around market expectations on the long end around how much stimulus is provided and future inflation. So we'll have to see there, and that's on the taxable marketplace and the Treasury marketplace. But the demand for not-for-profit senior living should continue to stay strong. All of you should be at essentially your lowest all-time average interest rates from the refinancings that have been completed through fixed rate debt and through bank debt. And you really should have strong access to capital to continue to grow at relatively low rates, ranging from, say, 2 to 2.5% for the strongest credits out 10 years with a bank deal, out to, say, 4.5 to 5% for strong unrated, and then 6% range for new campuses. So don't let capital hold you back on your strategic plan as you all continue to grow. And then we may be hearing about the return of advanced refundings, but that would likely be part of an infrastructure bill or a tax bill. And as I sit here today, people are not expecting a tax increase bill to come out while COVID is playing out. So by the time of this session, we'll see if we've learned anything more. But I am not optimistic that we'll see a reversion of advanced refundings until there's a larger bill, either infrastructure or tax, which likely would be in the second half of the year, if not near the end of the year. Lisa, next page. So we're ready to move into questions, but on closing remarks, I'll just note, again, thanks for allowing us to present. We love being and appreciate being a lead sponsor to Chisholm and glad to share this information. Lisa, you want to highlight the COVID information that ties to the other session?
Yeah, we have so much information here on our website. If you're having a hard time navigating it, just let us know. But you can get to this page through our homepage on Ziegler.com. So anything from PPP loans to technology resources. This is our Z News that you can see here, a screenshot. So all of these ongoing resources you can access on our website or through outreach to one of our team members. And talk about optimism. We're hoping to be able to get together. You know, we will be gathering virtually in April for our National CFO Workshop, but we're hoping to see many of you in person the first week of October for our annual Finance and Strategy Conference in Tucson, Arizona. So we know that's a great opportunity for leadership teams, board members to convene, and that always are a robust set of networking opportunities in a nice environment, as well as really strong educational content.
We're really looking forward to that, and that's just 2 weeks before the Leading Age Conference in Atlanta, and they're hoping to hold it live also. So by the time this is presented in the first week of March, hopefully we'll all still feel the optimism that we can get together in October.
I think that's it for the presentation, and what we will do is just transition here momentarily into discussion. So thanks, everyone.
Thank you.